As we head into the new trading week, the U.S. markets are closed for the weekend. We are looking at Tesla, ticker TSLA, which finished Friday's session on November 7, 2025, in a very telling position. The stock closed the official session at 429.52, which was a significant drop of 16.39, or 3.68%. This was a day of heavy trading, with the stock opening higher at 437.92 and even touching 439.36 before sellers took firm control, dragging it to a low of 421.88. Volume was substantial, clocking in at over 103 million shares. In the after-hour session, it did see a small recovery, ticking up about 0.59% to land around 432.05, but that does little to erase the damage from the main session. Now, the immediate expectation, the one you heard across financial media all day Thursday and Friday, was that the shareholder approval of Elon Musk's massive contingent pay package was a major positive. The narrative was that this removed a huge overhang, secured the CEO's focus, and realigned him with the company's ambitious future goals. Bulls like Dan Ives at Wedbush reiterated their strong outperform ratings, calling this a moment that secures the wartime CEO for the coming artificial intelligence developments. The expectation was that with this uncertainty gone, the stock could find a clear path upward. But the reality of the market is often a different story. The stock sold off hard on the news. This is a classic, almost textbook example of buy the rumor, sell the fact. The market had already priced in the high probability of the vote passing. Once it became official, the hot air left the balloon, and traders who had bought in anticipation of the event took their profits, leaving the stock to contend with the underlying fundamentals. And those fundamentals are precisely where the current tension lies. The common ground everyone can agree on is that Tesla is not valued as a car company. With a price-to-earnings ratio hovering near 290, you are not paying for 2025 car sales. You are paying for a future that includes autonomous robo-taxis, the Optimus humanoid robot, and a dominant position in artificial intelligence. The pay package itself is contingent on Tesla reaching a market cap of $8.5 trillion. This is the grand expectation. The challenge to this belief, however, comes from the company's most recent earnings report from late October. While Tesla posted a record $4 billion in free cash flow, it missed earnings per share estimates. The reason? Plunging automotive gross margins, which have fallen from peaks above 30% down to around 17%. This is the direct result of aggressive price cuts globally to spur demand against a wave of new competition, particularly from Chinese automakers like BYD and established players like Volkswagen and Stellantis in Europe. That Q3 earnings report showed that the record deliveries were largely fueled by a pull forward of demand in the United States, as customers rushed to buy before a $7,500 federal tax credit expired at the end of September. This creates a massive question mark for the current fourth quarter. Data coming out of Europe for October has been alarming for the bulls, with sales in some key countries reportedly down over 50% year over year. This is the reality that the stock is now grappling with. The AI narrative is a story for 2027 and beyond, but the car sales reality is hitting the income statement today. This is the battleground that defines Tesla's stock chart. Friday's 3.68% drop wasn't just about the pay package. It was the market refocusing on the very real, very near-term headwind of demand and profitability. The stock's 52-week low of 214.25 feels like a distant memory, but the 52-week high of 488.54 now also looks like a steep climb from here, as the stock is caught between these two powerful competing stories. This brings us to the significant short seller presence in Tesla. It's one of the most famously shorted stocks in history, and that remains true today. While the percentage of the float short has decreased from its highs, the raw dollar value remains enormous. According to the most recent official data from Nasdaq, which is reported twice a month, short interest as of mid-October stood at roughly 72.6 million shares. This was actually a decrease from the 86 million shares short reported in mid-September, suggesting some bears have covered. But 72.6 million shares is still a massive bet against the company. The short thesis isn't just a blind bet against Elon Musk. It's a fundamental argument based on valuation. The bears look at the 287 PE ratio, look at the falling automotive margins, and see a massive dislocation from reality. They see a car company valued like a high-growth software business right as its core market is becoming saturated and hyper-competitive. They see the Cybertruck ramp as slow and complex, and they see the robotaxi ambitions as years, if not decades, from regulatory approval and meaningful revenue. For investors trying to navigate this, it's important to know how to track this information. You can find the official short interest data directly on the NASDAQ website for the ticker TSLA. It's updated around the 9th and 24th of each month. But just seeing the number of shares isn't enough. You need to look at the days to cover, which NASDAQ also provides. For Tesla, this number is often very low, around 1. This is because Tesla's average daily trading volume is so high. A low days-to-cover ratio means shorts can exit their positions very quickly, usually in a single day. This is why Tesla is not a candidate for a short squeeze in the same way a stock like GameStop was, which had a very high days-to-cover ratio. There is simply too much liquidity. What's your take on the short interest? Is it a smart bet on fundamentals or just noise? Another metric to watch is the borrow fee rate. This is the interest rate short sellers must pay to borrow the shares. When that rate spikes, it can indicate that shares are becoming scarce and shorts are getting desperate, which can sometimes precede a pop in the price. Right now, Tesla's borrow fees are not abnormally high. Finally, you can look at the options market. The put-call open interest ratio is currently around 0.96. This is incredibly balanced, suggesting that for every bearish put option being held, there is nearly one bullish call option. The market is truly at war, with no clear consensus in the derivatives market either. The shorts are not a coordinated attack. They are a large, diversified group of funds who are making a fundamentals-based argument that the company's valuation has gotten ahead of its actual profit-generating ability. Their risk is that the AI narrative proves true, and that the Cybercab or FSD V15 does in fact change the financial model entirely. So, what is the company that investors are actually buying? The old business is selling cars, and that business is in a tough spot. The new business, the one that commands the $1.35 trillion market cap, is a diversified tech conglomerate. The Cybertruck is slowly ramping, with delivery starting in the UAE in early 2026, but it's still facing regulatory walls in Europe due to its design. The energy business is a bright spot, with Megapack deployments hitting a record 12.5 gigawatt-hours in the last quarter, providing a solid, high-margin hedge against the volatility of the auto market. But the real story, the one that bulls on platforms like X and Reddit are focused on, is autonomy and robotics. We are seeing FSD version 14.15 rolling out to Cybertrucks. Elon Musk has announced a new target of April 2025 for the start of Cybercab production, the dedicated robo-taxi. This timeline, like many before it, is seen as highly optimistic by analysts, but it sets a clear goal. This is what the bulls are buying. They are buying the possibility that Tesla solves autonomy first, rendering the discussion about 17% auto margins completely irrelevant. Comment below with what you think Tesla's biggest challenge will be in 2026, Cybertruck production or FSD regulation. The sentiment among retail investors is clearly split along this line. You have one camp that is meticulously tracking weekly registration data from Europe and China, panicking over the Q4 demand cliff, and you have another camp that dismisses this all as short-term noise, focusing entirely on the AI Day presentations, the new AI5 chip, and the long-term potential of Optimus. This disconnect is why the stock can drop 5% one day and rise 4% the next. Looking ahead, the expectation set by the bulls, like Wedbush's $600 price target, is that the company will successfully navigate this demand trough in 2025 and 2026 while the AI projects begin to bear fruit. The reality is that the next 2 quarters will be a severe test. The Q4 2025 delivery numbers, which we will get in early January, will be one of the most watched reports in the company's history. It will give us the first clean, unfiltered look at global demand without the pull forward from the U.S. tax credit. We will also be watching the 13F filings, which will be released over the next week to see if institutional smart money was buying or selling into this volatility during the third quarter. We already know that Cathie Wood's ARK Invest, one of the most prominent bulls, was trimming shares on Friday, a move they describe as routine portfolio management, but one that always gets the market's attention. In the end, the story of Tesla remains one of profound tension. The approval of the pay package was expected, and its inability to hold the stock up shows that the market is now squarely focused on the operational realities of margin compression and questionable fourth-quarter demand. The expectation is that Tesla is an AI and robotics company of the future. The reality is that it is currently a car company facing the most intense competitive pressure of its existence. Friday's 3.68% drop was a clear signal that, for now, reality is weighing heavier than the dream.